Would you think less of
Wait.
me?
Let's do like a proper countdown and everything for the start.
There was a countdown.
Oh, there was? Where?
Yeah, you missed it.
Okay.
We'll add it.
We can just leave it.
Would you think less of me if I told you that one of my first jobs out of college was working for a firm that sold Viatical Settlements?
Well, first I would need to know what are Viatical Settlements, and then I would make up my mind after that.
Viatical Settlements are life insurance policies sold on the secondary market, right?
That sounds quite boring. It's probably a lot better to say on the first date that I'm working in a Viatical Settlements industry than I'm working in a secondary insurance sales industry.
I mean, of all the things that I was expecting, boring was not one of those. It's like we are trading contracts with human lives.
Anything that says insurance or actuarial falls into that boring category.
Well, Viaticals, effectively what you're doing is you are buying somebody's life insurance policy. People generally get life insurance policies for their children, usually, to leave something behind in case something happens to them. And oftentimes they reach a place in their lives where they feel like they do not necessarily need to provide for their children anymore, right? The children might be grown up, they have their own jobs, they have their financial independence, or they're alienated. And sometimes people simply cannot afford to keep a life insurance policy alive and to keep paying premium. So when people want to discontinue a life insurance policy, traditionally they can go back to the insurer and they will be given back some small compensation. But this is usually a small fraction of the actual payout they would receive in case of death.
So people want to make more money, basically. They want to make as much money as they can on the sale of their own life insurance policy.
Well, yeah, in some sense, traditionally, insurances were holding their own clients hostage. Because the only place you could go if you wanted to get rid of your life insurance policy was back to the issuer, right? Sometimes in the late 80s, early 90s, you started getting these financial intermediaries who would buy life insurance policies from people that simply didn't want to keep paying premium anymore. Let's say you had a life insurance policy due to cash $10 million in a couple of years, or your life expectancy is a couple of years. They might come along and say, we'll give you $2 million.
But you don't need to pay your premium anymore, and you get the money right away.
And you get the money right away, right? I mean, at the end of the day, what's the discount rate on your money after you're dead? Right? I mean, that for some people, that money might have no utility. For a variety of reasons, you might want to cash in early, either to enjoy your remaining life or maybe even to pay for medical care. And of course, for the financial intermediaries, this could be very profitable because when the client dies, they're going to cash in on the full value of the policy. And again, there is this disconnect, right? The person with a limited life expectancy is applying a very high discount rate. And of course, for a financial institution, this could be big profits. To be clear, for a financial institution, after you bought this policy, the sooner the client dies, the more value there is. Because first, there is simple time value of money. Receiving money earlier is more valuable than receiving money later. But on top of that, you have the whole argument of the premia that need to be paid. When you buy somebody's life insurance policy, you need to keep paying the policy premia to keep it active. And of course, the longer the policyholder stays alive, the longer you're paying premia for.
This all sounds extremely fascinating, but we are planning to talk about short selling today. What is this analogy we're making here?
Well, I thought that in many ways there is a parallel here. While short selling is a way to bet that a company's performance will decline and to profit from the decline, when you're buying somebody's life insurance policy, you are effectively profiting once they die, right? So there is a similar profiting from the demise of others aspect here. And you're right. I wanted to use all of this to introduce the topic of short selling.
Basically, this Viatical Settlements industry is participating in a short position on a person's life.
That's a much more elegant way of saying it. But there are parallels also because this Viatical Settlements industry is controversial. On one side, they provide a valid service to this market. They allow people to sell, and that leads people to getting better prices than the monopolistic issuer would otherwise. On the other side, there is something intangible that feels wrong about profiting from the demise of others, right? And short sellers get a bad name because there is also an incentive to cause the demise of companies through rumors. There are these negative incentives. And when you're thinking of the Viatical Settlements industry, actually the very early beginnings were extremely seedy. Some of the early Viatical settlement industry started in Florida, actually, of all places. And we know of anecdotes of unscrupulous financial intermediaries buying life insurance policies of individuals, oftentimes who had stories of addiction. They were often targeting drug addicts and alcoholics. And then they were speeding up or incentivizing their demise. You can think about the incentives here. You are perhaps a drug addict, right? And you have a life insurance policy, and now you sell it for millions of dollars. Now you have a big influx of money.
You can buy more drugs.
Yes, correct. There were anecdotes where financial intermediaries were actually accused of facilitating or incentivizing that and effectively shortening the life expectancy of the people.
I mean, they didn't make a person an alcoholic or a drug addict, but because this person had access to more money, many of them chose to spend it on more drugs, which caused their quicker death. When we talk about short selling, we mostly will be talking about short selling of equities. It's less likely that these negative effects persist, but I can see the parallels. Basically, the main question we want to ask in this episode is short selling evil? And this is one of the evil reincarnations of short selling, where you facilitate a demise of a person.
Well, yeah, but some people in this industry were crossing the line. You're saying they didn't make a person an alcoholic or a drug addict, but sometimes they were targeting alcoholics and drug addicts and then were actually incentivizing them to celebrate, for example, right? When they signed a big policy, they would send a case of champagne or a case of whiskey to somebody who was recovering an alcoholic to celebrate the fact that they have just sold a life insurance policy. So some of this behavior, I'd say, did cross the line. Well, not to leave everybody with the wrong impression, that Viatical settlement industry eventually became much more sophisticated. By the time I was working in the late 90s, they were bundling. You weren't buying one life insurance policy, you were buying thousands, right? A portfolio, you were effectively bundling it into securities, right? You were securitizing it, and you were selling tranches of funds of insurances. So the seedy beginnings of that industry effectively got institutionalized and cleaned up. And yet this feeling of I'm profiting from an early demise of somebody still persisted, and so did some degree of controversy. And yes, you're right. We are asking, is short selling evil? Is short selling immoral? And then, it always did strike me. Some people do accuse short sellers of being immoral. Well, if betting against the life of a company is bad, betting against the life of a person is probably a lot worse. But
so
yes.
is the conclusion here then, if your new date tells you that they are working for a Viatical settlements industry, you should ask them which year they started. Because if they started kind of way back in time, your opinion of your date declines. But if they tell you that they have just recently started, now that the industry has become a little more cleaned up and standardized, then okay, that's okay.
Welcome to Questions in Finance.
a podcast where we translate academic mumbo-jumbo to answer interesting questions in finance. I'm Kate Holland.
And I'm Veljko. Kate and I met when we were PhD students at the University of Oklahoma.
Today, we're university professors, and we spend our days teaching and researching companies, markets, and all things related.
Today, we are asking, is short selling evil? And as always, we start with a slight tongue-in-cheek. The real, more serious question is short selling somehow immoral, right? And what we mean is, does it impose externalities on society? Does it somehow make others worse off? And perhaps should it, by implication, be restricted and regulated? That's a bigger conversation. Okay, Kate, so perhaps we should start with, what is short selling?
Yeah, and we will mostly discuss equity short selling here. So that is selling the share of a company short, though we will touch on a few other types of short selling, including exchange-traded funds debt, including sovereign debt, but mostly we'll concentrate on equities. So basically, when you sell shares of a company short, let's take Target, okay? Target recently had an over 20% decline in its share price.
Why are you targeting Target?
Because Target recently had a big
They have
drop.
a target on their back?
They might feel targeted. If before their earnings release, I looked through their numbers and went to their stores and figured out that they're not doing as good as Walmart, I could have had an expectation that their share price will be declining because they are underperforming. So then to bet on the decline...
This is a hypothetical, right?
It's a hypothetical, but it's a convenient example to target.
Okay.
Because they just did have more than a 20% decline in their stock price, which I guess I should say around the 25th of November, 2024. This is the opposite of how we think about participating in companies' performance. We usually think about, okay, this company is going to do great, its share price is going to go up, so I buy it low, and then the share price is going to go from 100 to 150, and I make a lot of money. This is thinking about it the other way. It's the share price right now is at 150, but I see the company performance is not up to par, and I think it's going to go from 150 down to 100. So how do I participate in that trade where I expect the share price to decline because I think performance is going to be bad? Do you want to talk about how this actually happens, like the details of the actual trade when you short the stock?
To recap, the company is trading at $150 per share. I have a negative outlook. I think they're going to decline in valuation. So I borrow shares. That's what starts my short selling transaction. You call a brokerage, a large financial institution or whatnot, and you borrow shares, sell them on the open market at today's price, presumably $150 per share. And then you wait a certain period, and let's say that you're right, a month has elapsed, the price per share of this company has indeed declined. It's now trading at $100 per share. You go buy the shares on the open market again at $100 per share to close your borrowed position.
Returns the borrowed shares.
To return the borrowed shares, right?
Yep.
So you sold at 150, you repurchased at 100, and you made a profit of $50 per share from this decline. Of course, whoever lent you the shares is not doing it for free. There is a borrowing fee that you're paying. To be clear, for most, as you said, we are most talking about equities here on US markets. Those tend to have very liquid borrowing markets. Those borrowing fees tend to be fairly small.
Right.
Now, not always, right? There are particular instances, so-called short squeezes, when the availability of shares on the open market becomes lower and borrowing fees.
Many people want to short the stock.
When the demand for share really skyrockets. But those are extreme cases. For the most part, it is relatively cheap to short.
We should probably mention that this is the most typical way to short sell a company, but oftentimes traders also use put options. There's a paper in the Journal of Financial and Quantitative Analysis in 2020 showing that put option volume is also related to short selling. So a put option is an option to sell some shares of stock at a certain price in the future. You would be purchasing puts thinking that the price will decline.
You're right, Kate. There are other ways to bet against a company. And you're right, put options are one such way. In some ways, I always found that isolating or targeting short sellers for benefiting from the decline of a company seems selective. Why do we have an issue with short selling and not with buyers of put options, right? They all face the same set of incentives. And
I think there's an issue with both.
I don't hear the same level of popular opprobrium. Think about the GameStop saga, right? Where the internet came out criticizing short sellers for profiting from the declining valuation of GameStop. And I don't remember anybody singling out put option buyers of GameStop.
Right.
But perhaps we'll return to GameStop later on. We were talking about the basic definition of short selling. And I think one thing that we should make clear is that it's a very risky transaction, right?
There's no closing off of the prices for your trades. The downside here is kind of flipped, right? The stock price can keep running against you into infinity.
What you're trying to say is that, of course, once I have to close my position, I have to buy shares at the open market, right? And of course, if I'm wrong and those shares, instead of declining in value, increase in value, I incur a loss, right? So, of course, in our previous example, if those shares, they started at $150 per share, if instead of declining to 100 like I'm expecting, they go up to 200, now I'm losing $50 per share, right? If they go to 250, I'm losing $100 per share. If they go to 300, right? And to the extent that prices
keeps going up and up. That's what I meant. Like, yes, there's upside is unlimited.
I was just parsing out your statement for those of us whose minds are not as fast and as far-reaching.
Oh, maybe my statements aren't as clear today. But what I want to mention is think about it. What do you need to know to become a short seller? For you to decide that share prices of a company are going up or down, you need to really evaluate the firm, participate in this basic stuff that we teach in our finance classes, where you evaluate your company at its very base, figuring out future revenues minus costs. But there's many minute details about revenues, which markets the company is at, what products they have, and costs. What is their cost of goods sold? What are their taxes? What are their expenditures on investment and capital expenditures? All of these minute details fall into this valuation model, which really boils down to how much money is this company going to make after you pay all of the costs that it has, translated into today's dollars. So it's really a lot of information that short sellers need to be processing about the company to figure out that the firm isn't doing as good as everybody else thinks it's doing right now, to know that the price of this company will be declining.
Short sellers have a strong incentive to discover negative information about companies, right?
Let me translate it with examples to things that are more close to heart, to more people. And I'm going to motivate my explanation by the example from GameStop. GameStop was one of the heavily shorted stocks a few years ago, and for very good reasons, because if you looked at the business model of GameStop, it was outdated. And if you looked at their revenues over the last few years, they were going only one way, which is down.
What perhaps not everybody understands is how reliant GameStop's revenue model was on physical distribution of video games. A very large portion of their revenue came from the resale market for video games when those were traded on CDs, DVDs, previously cartridges. With gaming moving to an online, on the cloud, and in general, download from online stores distribution model, that revenue model seriously suffered, right?
So you're making a great point, because if I gamed, which, I didn't when I was growing up, but if I did, I can see how I would be emotionally attached to these cartridges or whatever, like things that you have the games on, right? And so if somebody would tell me, look, this is not going to be there in the future, my emotional connection to that would be shaken, and I would be deeply upset with that statement. And
Sure.
GameStop had a lot of short positions on it. And a lot of retail investors decided to rally against short positions, thinking that these shorts are making GameStop become bankrupt, where in reality, they were just doing their financial analysis. They were honestly telling the market, look, we think that this company doesn't have good future prospects. But this emotional connection of a lot of retail investors made them support GameStop and go against these huge hedge funds. The retail investors did run the price of GameStop up quite significantly, which hurt a lot of hedge funds in their positions.
I think it's a beautiful example of the tensions, right? Because as we start talking about the pros and the cons, if you will, or the arguments in favor or against short selling, we're going to see that this incentive to uncover negative news is one of the big positives. We're going to see a lot of research finding that short selling prevents bubbles and reduces mispricing of securities.
Let's talk about that positive. Obviously, there's positives and negatives that we'll discuss for short selling. I would say let's start with the positives, just because that's where the research findings end up pointing to. And negatives are more popular, and that's what everybody knows about. Let's talk about the positives of short selling, since we brought up this ability for there to be better prices and fewer bubbles. Let's mention that as the first benefit.
Eckhard Boehmer and Julie Wu have a seminal paper there. But truly, there's a lot of research that confirms these findings. But I'm talking about a paper Eckhard Boehmer and Julie Wu published in 2012 in the Review of Financial Studies. They effectively find that short selling makes prices more efficient. And what they really mean with that, they find that prices show smaller deviations from fundamental values, and not only smaller deviations, but faster realignment. So they effectively find that information, and in particular negative information, is incorporated in prices in a faster manner. And if you think about how markets function, we have too few voices that have an incentive for negative news to spread. Managers don't love to spread negative views about their own companies, right? Even shareholders, right? If I'm a shareholder of a company, am I really incentivized in spreading my negative opinions? Not always. And we know that analysts and auditors are also, in many ways, the incentives are not as clean, as honest as they should be, right? At the end of the day, they're all fed by the same companies. So,
yeah, that's a good point, that short sellers really bring up some of the negative information. Obviously, nobody likes the negative angle, but if it's truly there, it needs to be uncovered for prices to be more efficient. And yes, the papers that you are mentioning is important. There's many papers that look at individual stocks and find this relationship between the short selling volume and more efficient prices for individual firms and lower performance down the road for individual firms. But it's not only on the individual firm level. David Rapash, Matthew Rindenberg, and Gofu Zhao in 2016 published the Journal of Financial Economics paper, where they look at the aggregate market short interest, so not just individual firms. And they show that this aggregate short interest is the strongest known predictor. That's a strong statement, strongest known predictor of the aggregate stock returns, meaning that when the short interest is high, future stock returns are going to be lower. The short sellers are usually right on average about predicting lower performance in the future, not only for individual firms, but also if you look at the overall market as well. It's also interesting that paper points out that the economic source of this predictability from short interest is mostly coming from the cash flow channel. The short interest can predict lower returns, lower stock prices in the future, because it somehow zooms in on this sales minus costs cash flow channel for a firm.
You're interpreting the fact that short selling is followed by a decline in prices as meaning that short sellers are correct in their predictions. And yet, for those who are critical of short sellers, The counter argument could be that short sellers are causing the decline by targeting firms. This is where short selling becomes controversial, because there is a fine line between an incentive to spread negative information and an incentive to disseminate rumors or false statements, what short sellers are sometimes accused of doing. And we'll talk about the negatives later, right? But interestingly, one of the things that you've mentioned is this idea that short sellers spread information that we're kind of giving for granted, but that might not be obvious to everybody. It's fascinating how some of these short selling firms actually operate when you see them in action.
Muddy Waters, one of our favorites, I'd say, right?
Correct. They're one of the short-selling outfits that have specialized in effectively uncovering dirt about firms and then effectively disseminating research reports. They'll send reports to the media saying, we allege that firm X and Y is doing this and that. And then disclosing, of course, that they actually hold a short position. And this often becomes extremely controversial, and sometimes these short sellers get caught into extreme legal fights. And it was interesting earlier when you were describing short sellers and you're saying they're digging through the books of companies, and you're right. I mean, a lot of this is just a lot of forensic elbow grease, and yet when I'm thinking of short sellers, and maybe I have more of a romantic view, but I'm thinking of the swashbuckling forensic investigator traveling to remote corners of the world to discover the gold mine was not real, but it was salted, right?
Or you're talking about the electric vehicle company that didn't actually have an electric truck, right? They just created these awesome videos, but there was no actual truck there, just like there's no gold mine.
Yeah, you're right. That's the kind of episode that I'm thinking of. So what you're referring to is Nikola Trucks?
Yes.
Right? This is a company that was trying to be the Tesla for 16-wheelers, right? And in a truly depressing lack of imagination, they called it Nikola, right? Nikola Tesla. So the interesting story here behind Nikola Trucks is they, at their peak in 2020, late spring, early summer, this company reached a market capitalization of $30 billion. And at some very brief period of time, this electric vehicle, electric 16-wheeler startup that you've never heard of was worth more than Ford. Until sometimes around July 2020, Heidelberg Research, which is one of these short-selling outfits, started publishing reports alleging that the company was lying about the state of its technology. There was one particular video that the company had released. They were filming a truck from weird angles. Some people became suspicious of these weird angles, so they figured out the location where this commercial was filmed and actually realized that it was a steep hill, and that made them think the truck was not running, but it was just rolling downhill, which made them question the technology. That led to them digging into the company and finally finding a couple of engineer whistleblowers that claimed that the company actually did not have the technology that they claimed it had, and that the trucks were not operational. Heidelberg published research. The Wall Street Journal actually partnered with them in publishing some investigative reports. At first, the company pushed back and denied all of it. Eventually, it was found out that Heidelberg was right. And the company is actually still around. Many companies don't recover from
the market capitalization is a lot lower.
Yeah, I think it's down like 98%. I think they went from 30 billion to, at last I checked a couple of days ago, it was 122 million.
Wow. The interesting thing is that short sellers, they do get creative in figuring out this information. As you mentioned, nobody wants to disclose negative information. And so oftentimes it's hard to find it directly in the financial statements. So, but one thing that's been shown to be true is that behaviors end up being very consistent through time. If you are a liar in one thing, you'll be a liar in another thing. If you are a cheat in one thing, you'll be a cheat in another thing. Muddy Waters used this basically idea to look up educational records of CEOs of multiple companies to see whether everything was correctly stated. So they identified CEOs who lied about their educational achievements and published that data.
I vaguely remember that story, and it was some stupidly high proportion of CEOs, right? I think they were looking at Fortune 500 companies, and something like 20% of these CEOs on this list were lying about their educational credentials in some way, shape, or form.
On the one hand, you can say, now there is a CEO of this company and they're making me a ton of money. But what they ended up discovering, if these CEOs lied about their educational achievement, then this company had a lot of skeletons in their closet. They had option backdating, they had more accounting restatements, they had more of balance sheet liabilities, and all of these things started coming out that were nicely hidden. So this wasn't the only incidence of misstatement or fraud that the CEOs had taken. And so that was a way to look into the information that they didn't want to disclose, this negative information, and glean it from this consistent lying behavior.
Absolutely. And I will also say, before we return to academic research, I admire these short sellers, these outfits. It takes a lot of guts to be contrarians. Nobody thanks you for it. In many ways,
you are disliked, and people think that you are the bad guys making all the companies fall apart, where you're not really the big bad guy. You're a small company who's actually taken positions against a lot of institutional investors.
One of the things that we haven't mentioned is short selling in Europe is a lot more vilified than it is in the United States.
Tell me, I would like to hear.
European finance has always been a little bit more genteel and a little bit more cooperative. The hostile M&As were always seen as, that's what American cowboys do.
Totally see that. You mentioned one more really interesting instance related to Europe.
Wirecard was a big payment processor, right? What made this story particularly controversial is that Wirecard was one of the very rare success stories in Europe in the tech sector. Europe hasn't created the tech giants that the United States did. Yeah. And Wirecard was one of the few exceptions at some point. And even there, it was a relatively weak success story because effectively Wirecard was a payment processor that was wading everywhere Visa and MasterCard didn't want to touch. They were working with a lot of cannabis dispensaries, pornography websites. They were working in parts of the world where Visa and MasterCard didn't really want to step in.
And SIM businesses.
Correct. And the interesting thing is, for almost a decade, starting as early as the mid-2000s, short sellers and journalists have been alleging that Wirecard, that there was something fishy in their business model and that simply some of the reported numbers just didn't add up. And early on, there were allegations that their actually Asian businesses were growing way faster than kind of made sense. The interesting thing is that as early as 2014, actually, journalist from the Financial Times, Dan McCrum, starts writing negative stories about accounting in Wirecard after receiving tips from John Hampton, who was also a famous short seller. I think he's Australian, if I remember correctly, right? And Wirecard immediately pushes back very strongly to the point that they actually ran to the German's Federal Financial Supervisory Authority. This is the Security and Exchange Commission of Germany. The German authorities react first by banning short selling of Wirecard, right, and forcing actually existing short sellers to close positions, right, and then actually opening investigations first after against the Financial Times, alleging that the Financial Times was manipulating markets, and then specifically against Dan McCrum and Stefania Palma, who was actually another Financial Times journalist working in their Singaporean office and investigating what was happening in Singapore.
Imagine being Wirecard at that time, like you're an executive in Wirecard, you know what these journalists have revealed is indeed true. And then you choose to fight against it, to say that, this is not true, we're not like that.
Well, it's actually fascinating to look at, these CEOs were totally outraged. And again, there is a huge degree of nationalism here, right? Because as you can imagine, these are German champions of the German industry in front of German regulators, in front of the German press, talking about the short sellers coming from the UK, from the United States, from Australia, alleging fraud. There are very strong nationalistic undertones here in this whole conversation. But the point is, for almost 40 years, these German financial services authorities keeps investigating, dragging these journalists in and out of court, fining the Financial Times. The Financial Times ends up appealing it. In the meantime, under more and more scrutiny, Wirecard ends up hiring a new auditor, and then this auditor cannot find evidence of a $2.6 billion cash account that Wirecard alleges or had alleged all along to have. Mm-hmm. And this leads them to unravel, and eventually they admit that, David McCrum, the short sellers, were right all along. But you go from being a villain accused of manipulation to being the hero that uncovers fraud.
It's a very interesting, fascinating story. But as we said, on average, short sellers are right. But I was thinking as you were saying that, what could have Wirecard done if these allegations were not true? If for some reason this Dan McCrum was actually spinning a story that wasn't true. There is a paper by Leon Sbargeron and Alice Bonamy. It's a Journal of Financial and Quantitative Analysis in 2020, where they address hypothetically, what if this Dan guy was not telling the truth about them? What Leon's and Alice show is that companies that disagree with a short seller statement, they actually end up buying their own stock or repurchasing their own stock, and their executives also purchase additional shares. So basically what they're saying is there's some negative information coming out about us. We're just gonna buy more of our stock because we think it's undervalued. We see our current projects and we know there's awesome projects that we have under the covers. Leon's and Alice end up showing that these purchases appear to be motivated by some private information of managers because future earnings do end up being more positive. So what can you do if you want to signal that short sellers are not correct? You're just gonna keep performing awesomely into the future, keep producing good products, blowing out earnings expectations and having higher revenue projections, and repurchasing some shares. On average, short sellers are correct, but there are some instances where they're not. How can firms push back against short sellers? They can keep performing well and they can repurchase their stock.
Interesting. If you're an external observer of this battle, how do you read into that? How do you interpret this signal from the outside? You have all this literature telling you that short sellers trade when they're informed. We haven't made this explicit, but it's because there are these huge risks that they're taking. It's because they're paying borrowing fees. So they only trade when they have a certain degree of confidence. That's why, on average, when they trade, they're right. On the other side, you have this literature saying that managers, when they trade out of their own pockets, their own stock, they're usually right. They're not supposed to have inside information, and yet we know that they do. It almost feels like when you have the unstoppable object meeting the immovable object, what happens? You have these two forces clashing, the informed short sellers and the informed managers. And yet, I don't think that, as a manager, you can increase the value of your shares by repurchasing them. I don't think this is causal.
No, they are repurchasing them because if the prices have gone down a bit, they think that this is a good opportunity, basically.
They repurchase them because they know that they're undervalued. Yes. Absolutely.
As you said, Europe has a lot of objections to short selling, more so than the United States. And I want you to mention one more objection that Europe has to short selling that's even more interesting.
One of the arguments against the ethics of short selling is statements coming from the Pope, the statement coming from the Vatican, right?
Right.
And in some sense, it almost feels like, why are we even talking about this? Because the Pope has spoken. The Pope has spoken. The Vatican has said what they think. They say short selling is immoral. They say short selling shouldn't be done. And it's like, well, game over, right?
I think they received some really good, educated replies to their statements, and I hope that they've adjusted their statements after reading those replies.
Actually, no, this is interesting. No, they haven't, by the way.
So tell the story. Tell the story.
What you're talking about is a bit of a back and forth between the Vatican and American regulators. Started in May 18. It was May 17, 2018, when the Vatican actually published a bulletin. These are official proclamations of doctrine of the Vatican, which, if you're Catholic, mean truly a lot. This bulletino, published on May 17, 2018, is titled Economiche et Pecuniarie Questiones, right? Or questions about the economy and money. In English, it was translated into considerations for an ethical discernment regarding some aspects of the present economic financial systems.
Wow, a lot longer.
Seems like a bit liberty in how they took that. But this was the Vatican actually issuing these extremely strong statements against modern financial markets, in which in particular they were singling out as immoral actions that, and here is their language, actions that permit gambling at the risk of the bankruptcy of a third party, or actions that create a unique case in which persons start to nurture interests for the ruin of other economic entities, and shapes an event of a kind of economic cannibalism. It's really a bit of a convoluted statement, right? Effectively, the relevant part here is they're saying that it's immoral to engage in any contract that permits gambling and creates a case in which you nurture an interest in the ruin of other economic entities.
Oftentimes, you are not nurturing this interest. That is already there. You're just disclosing the information and actually allowing for more efficient prices to be happening.
No, but what they mean with nurturing an interest, they mean carrying an interest. In other words, profiting, right? What they mean is,
I see.
They're effectively saying that having an exposure to a profit that emerges from the ruin of others is automatically immoral.
It's okay if you're profiting from when prices go up.
So, no, they don't say anything about prices going up. They're singling out as immoral the act of profiting from ruin. That's immoral. Now, the language actually gets more specific later on. And here is where I think it gets really interesting. They reserve special reproach for what they describe as naked purchases of protection on sovereign nations. Just to finish the position of the Vatican, they single out gambling that a nation will default. And then they actually specify that such purchases are considered, quote unquote, extremely immoral actions, and specifically because they benefit from enormous damage for entire nations and a million families. Effectively, they're saying it's the fact that you're profiting from the misfortune of a large number of people, of entire nations, that makes it particularly distasteful. And then finally, they actually say that this calls for sanctions of maximum severity, which, I mean, that's kind of scary when it's coming from the Vatican, right?
What are sanctions of maximum severity from the Vatican?
They don't say. This is from an institution that, this ranges from Inquisition, level torture, to
well, I don't think that's
damnation.
Implemented anymore. So what's the worst in current days?
Eternal damnation?
What about something a bit more tangible than internal damnation? Is there something more tangible?
I don't know. Did you read Dante? I mean, that some of those circles of hell are pretty.
No,
pretty
I mean, like in
tangible.
Inquisition, you lose your head, very tangible. But this internal damnation, it's very intangible. So, like, what is the most tangible sanction, I guess, right?
Well, again, Kate, Christmas is approaching. I'm gonna be glad to gift you a copy of Dante's Inferno.
This does not solve the intangible, tangible issue. I want to see what is the most tangible sanction imposed.
I'm not going to talk about torture and all the kinky stuff that happens in hell in Dante. But to go back to our point, people that took the proclamations of the Vatican a little bit more seriously than your heretical self were actually the people at the head of the Commodity and Futures Trading Commission.
I see where the statement is coming from, but I think it misses the full picture. It only is capturing a very small piece of the picture. And as we know, the road to hell is laid out with good intentions. So I think this is a perfect example of that statement, because they're pointing out one issue, but what they're not realizing is if short selling of these sovereign nations goes away, these nations will never have access to debt that's basically cheap enough for them to live on.
You're absolutely right. I think this is a fascinating story, like a fascinating anecdote, and it gets better when you start reading that shortly afterwards, as we were saying, the Commodity and Future Trading Commission issued a very strong reply to the Vatican. And this was actually Christopher Giancarlo, the chairman of the CFTC, and Bruce Tuckman, the chief economist of the Commodity Future Trading Commission. Right? And to be clear, the CFTC, they regulate a lot of the derivatives markets of complex financial instruments.
Right.
And the Bollettino was also singling, when they were talking about these naked protections, credit derivative spreads, CDS contracts, right? So on July 21st, 2018, the chairman and chief economist of the CFTC co-signed a letter in reply to this Bollettino. And I just love how it starts, right? I hope you won't mind if I just read the beginning of it, but it starts with, Your Eminences, the Congregation for the Doctrine of the Faith, the official name of the Vatican's Holy Creed that issues these documents, recently published the above-referenced bulletin on economic and financial issues. Building on the premise that no area of human action is outside ethical principles, the document lays out ethical foundations to govern economic and financial systems, including in the usage of derivatives. And then they say, we thank you for such a thought-provoking reflection. And then they just go on the 20 pages of schooling the Vatican on how financial markets work and why these are important instruments. I love some of the arguments that they make. They're really talking about how these instruments and how short selling allows farmers to protect themselves from downside risk, which allows them to provide food for the world at lower prices.
Right.
And anybody interested in the arguments in favor of financial markets contributing to society. And again, it is a two-sided argument, right? I mean, it's not that I don't see the counter argument or the downside. But yet, these guys make a very cogent, extremely well-articulated argument for the social utility of derivative markets and of short selling. I invite anybody interested in this topic to really read it. I haven't found any indication of the Vatican responding to this document, but shortly afterwards, the Vatican announced that they were banning short selling for any of their own investment funds.
The Vatican has an investment fund?
The Vatican's bank actually has one of the oldest, largest investment vehicles operating in Europe. It's an institution that was mired in all sorts of scandals. The heads of the Vatican Bank tend to die violent deaths, right? And there were some really fascinating stories about that.
I'm thinking about all of this, what we've talked about, GameStop, Vatican, and this general perception out there that short sellers are bad, which we don't see empirically. We see empirically with research that they indeed correctly predict worse performance of different companies. They make prices more efficient. But overall, why is there this negative perception? I think it comes back to a very emotional perspective, back to your video games, right? It's kind of like people who are missing those cartridges. I think people think about short selling and they can even turn it into personal examples. So of course, that elicits negative emotional responses. So I think that GameStop and this response from the Pope and this general feeling that short selling is not good.
In some ways, you are going back to the eternal debate of are short sellers correctly predicting a price decline that would have happened anyhow,
yes,
and perhaps accelerated it, and in a Schumpeterian sense of the word, helped redeploying assets to a more efficient use, right? Which I guess is the interpretation that most of the literature finds towards it. Or are they, on the other side, causing the decline?
Yeah.
Which is what at least some people are accusing them of doing.
Right.
Most of the evidence in the literature seems to be on the former rather than the latter, right?
Mm-hmm.
But then again, averages don't necessarily tell the full story, right? But I think there's an interesting paper by Asher Curtis and Neil Farger. This was published in Management Science in 2014. The paper's title tells the whole story. Does short selling amplify price declines or align stocks with their fundamental values? I love this paper because they're really getting to the fundamental question here of, is short selling correctly leading to a decline in overvalued securities, or is it actually causing declines in securities that are targeted, right? And I'll quote here their abstract. They start with, critics of short selling argue that short sellers amplify price declines by targeting firms with falling prices in an unwarranted manner. Contrary to this viewpoint, we find that increases in short interest for firms following a price decline are associated with measures of overpricing based on financial statements analysis. So they're saying that you can see in the balance sheets and income statements of these companies evidence of deteriorating performance that short sellers are capable of spotting and identifying perhaps faster than other market participants.
Right.
When we talk about how short sellers help incorporate negative information in prices faster, there are two distinct mechanisms. One of those is the direct action of trading, right? By borrowing shares and then selling them on the open market, you're increasing supply of shares, and an increase in supply, all else equal, leads to a decline in prices. And yet this mechanical effect is probably even less important than, as we said earlier, this incentive to dig out, uncover, and disseminate negative information, right? But as we were saying about pricing efficiency, right, I think it's also important to link this idea that it's not just that these mechanical pressures are going to lead to better pricing of individual securities. There's a lot of evidence out there that short selling will lead to fewer bubbles. And there were actually various papers looking at restrictions on short selling around the world and actually finding that effectively when you have more short selling, or when you allow more short selling, your economic cycles effectively get weaker. They smooth out, right? In other words, what we're talking about here is pretty much every economy around the world seems to go over a periodic boom and bust cycle. And there is this eternal debate of why do we have these periodic bubbles, right? And one of the reasons is because restrictions on short selling, right? And if you think about it, there's something interesting that we didn't quite talk about in the price discovery process. Financial researchers, especially those crazy people in asset pricing, they're a lot smarter than us, lowly corporate finance people, right? They tell us that prices are indicative of the prevailing opinions in the market, right? But the reality is that anybody who thinks a stock is undervalued can buy it, which effectively pushes this desire to buy something, this demand, will push the stock price up. And yet, only the people who already own a security can sell that security if they think it's overvalued.
Well, so you can sell it short, right?
The absence of short selling, that is, right?
Oh, in the absence of short selling.
That's what I'm trying to say. That's why short selling is such an important mechanism and I think that gets lost a little bit in all these conversations. The fact that you have this asymmetry in the absence of short selling, which pushes share prices up constantly and leads to bubbles. Short selling helps mitigate that. That's really one of the big benefits of short selling. Now, when it comes to bubbles and short selling, theoretical literature is extremely clear in its predictions. And there are various models here, but effectively, the intuition is pretty simple. By helping to incorporate negative information in a more efficient and faster manner, short selling reduces the possibility of a security becoming overpriced, and hence it reduces the likelihood of a bubble. So fewer bubbles forming equals fewer stock price crashes, and especially at a market-wide level. So, for example, there is a paper published by Jose Schenkman and Wei Xiong, and this is in the Journal of Political Economy, published in 2003, and the title is Overconfidence and Speculative Bubbles. It's a theoretical paper that shows that asset price bubbles happen because of a combination of two factors: overconfidence by at least some traders and constraints on short selling that prevent other more rational traders from arbitraging this overconfidence away. And as I said, this is just one paper, probably the most cited in this theoretical space. But for example, there is another paper published in 2006 in the Journal of Finance. This is by Hernan Harouvi and Charles Nosser. And the title here, The Effect of Short Selling on Bubbles and Crashes in Experimental Spot Asset Markets. The conclusions are similar. You ban short selling, you get more bubbles, and after more bubbles, you get more crashes. Now, while the theoretical literature is very, very clear here, there is at least some degree of disagreement in the empirical literature whether these theories actually translate on the ground. There is one very highly cited paper on the yes side. This is Arturo Briz, William Gotzman, and Ning Zhu. In 2007, published a paper titled Efficiency and the Bear, Short Sales and Markets Around the World. This paper effectively looks at 46 equity markets around the world, and they look at restrictions on short selling. And what they actually find is that markets in which short sales are subject to greater degrees of restrictions or are outright banned suffer from a greater chance of bubbles forming and subsequently more stock price crashes after these bubbles finally deflate. Well, I guess I'll mention another paper that does find that short sales reduce the likelihood of bubbles. This is Stefan Nagel in the Journal of Financial Economics in 2005, Short Sales, Institutional Investors, and the Cross-Section of Stock Returns, where he effectively finds that in the presence of short sales, stocks are less overvalued and they deviate less from fundamental prices, which again, it's not directly addressing bubbles, but it's finding evidence very consistent with the idea that you allow short selling, you get less overpricing. But as I was saying, not everybody agrees. There is, for example, work by Robert Battaglio and Paul Schulz, published in the Journal of Finance in 2006, paper titled Options and the Bubble, and they actually ask whether short selling actually had any role in reducing overpricing of internet securities during the dot-com bubble, late 90s, early 2000s, and they actually answer negatively. They actually conclude that short sales did not help keep prices in line during that particular bubble. In all defense for the argument pro short sales in this context, I think that, looking at one particular episode in which there are already some degree of constraints on short sales, and then concluding short sales are not helpful in reducing bubbles, that seems a little bit unfair. And I'm, in their defense, I don't think that Battaglio and Schulz originally meant it that way, but I know that paper is cited at times as evidence against this idea that short sales help reduce bubbles, and I'm not entirely sure that's what I would take away from it. So from a theoretical standpoint, the predictions are clear. Short sales should reduce bubbles. From an empirical standpoint, the evidence is a little bit murkier, and yet you're not studying unconstrained short sales, right? Every time you're studying short sales in the real world, every regime, every country restricts short selling to some extent. So you're always looking at what impact does constrained short selling have on market quality.
I think there's another way through which short selling works. Not only is this mechanical, more shares, or, we've uncovered more information, it also makes prices more efficient because of fear. It's a disciplining mechanism after all. Because short selling exists, it brings in the discipline to where managers and executives end up behaving better as well. What do I mean here? They're more honest in their earnings. They're less likely to manage earnings. And there's actually 2 papers that discuss that. There's Vivian Feng, Alan Huang, and Jonathan Karpov, 2016 Journal of Finance. Jonathan Karpov has been known to work in the fraud literature a lot. He's written a lot of papers on fraud. And basically, their paper is saying that short selling helps detect fraud, and it also curbs fraudulent activity through the disciplining mechanism. And another paper is Massimo Massa, Bohui Zhang, and Huang Zhang, 2015 Review of Financial Studies, so just slightly before the first paper I discussed. And they basically reach a very similar conclusion. It's just that these 2 papers examine 2 different time periods. The Massimo Massa paper examines 2002 through 2009 time period. Johnson Karpov's paper examines the 2005 through 2007 SEC pilot program for Russell 3000 index stocks. It also has this additional angle of being a disciplining mechanism.
Yeah, so this is, I would say, a distinct benefit of short selling. Number one, short sellers improve price efficiency. With better price efficiency, you get fewer bubbles. Now what you're talking about is this other benefit of short selling, which is effectively an improved governance mechanism. And yes, I fully agree. Once managers know that somebody has an incentive to uncover bad behavior, their incentives to misbehave decline. They should behave in a more honest manner. Yes, and these papers, they mostly use earnings restatements, right? If afterwards the firm has to restate earnings.
There was some funky business happening in the first place there. They were misstating them.
Correct. You're absolutely right. Now, we know that pricing effects are one of the benefits of short selling. We spoke about the governance incentives and how short selling leads to
discipline.
Yes, managerial discipline. What we haven't spoken about is perhaps the less sexy, but actually probably most important part of this literature that looks at the market.
Microstructure. You're going to start talking about bid-ask spreads and all that. And dealers managing their inventories. I'm already a bit bored, but I agree this is a very important aspect. So yes, let's talk about this paper by Jonathan Brogard, Terence Hendershort, and Ryan Riodaran, Journal of Financial Economics.
How could we not after such enthusiasm, right? So market microstructure is a branch of course, the finance literature that if you're not a researcher, you might be less familiar with. But it's a part of finance that deals with how the plumbing of markets works. How do markets clear? How are auctions designed? How do trades happen? And short sales and high-frequency trading are 2 very big topics in the market microstructure literature. So here you're catching a paper that sits at the intersection of these 2 huge topics, Brogard, Henderson, and Riordan. It's a paper on high-frequency trading and the 2008 short sale ban. They find evidence that short selling allows liquidity providers to hedge or to manage, if you will, inventory risk. The whole point is when you want to trade, when you want to buy or sell a security, the average person, trader, investors will contact a financial institution, right? And this financial institution will be ready to buy or sell. The fact that they're ready to buy or sell when you want to trade is what we in finance call providing liquidity. Mm-hmm. So providing others the ability to trade a security, right? And what we need to understand here is that in order to trade securities, these financial institutions have to carry inventory. If somebody wants to buy shares of Apple, the financial institution has to have shares of Apple on their inventory, right? And the act of carrying inventory is expensive. Inventory needs to be financed, but more importantly, inventory carries a risk. If I carry shares of Apple in my inventory, there is a risk that these shares will decline in value and that will hurt me. Financial institutions want compensation for the cost of financing their inventory and compensation for the risk of carrying inventory. Now, where this becomes relevant is that short selling, by allowing you to bet on a decline of the value of financial security, can allow you to effectively hedge a long position, right? In other words, if you hold shares of Apple, you can short sell shares of Apple, and now you are hedged in the sense you're neutral in terms of whatever happens to shares of this company. So what Brogan, Henderson, and Riordan are effectively saying is that these financial institutions, when they're allowed to short sell, can manage their inventory risk more easily, which allows them to provide liquidity at a cheaper rate. What that effectively means for all of us is that we can trade faster, that our trading orders are executed faster because institutions have larger inventories, and that we can trade with cheaper expenses.
So what they actually do later is that they split high-frequency traders, which are not going to be people, these are computers, and non-high-frequency traders, which are people like me and you. So what they show is that non-high-frequency traders, which is people, their short selling indeed improves liquidity. But if high-frequency traders, aka computers, are trading, the short sales associated with high-frequency trading is actually harmful to liquidity.
Yeah, I love that, right? Because I think in all these conversations about means, we lose sight of the nuances, right? And I think it's important to say that all of the papers we've cited so far are going to find that on an average, short selling has positive effects. But that's not to say that there are no corner cases or anecdotes of malfeasance. And yet, digging in these papers, we haven't really found much of it. And I will say, we have our own work, right?
Please tell us about your paper. That will be interesting to hear.
We have a paper published in the Journal of Financial Economics in 2014. And with we, I mean Vikas Raman, Pradeep Yadav, and of course myself, where we actually look at the impact of naked short selling on market quality. Naked short selling is short selling without pre-borrowing, right?
So how did you get interested in that question, and what did you expect to find before you went into the paper? Before you started working on it? What attracted you to that? What's so interesting about it?
No, I love the question, and you're absolutely right to be asking this, because we were thinking that if there is any corner of the short selling market that is dubious and possibly has negative consequences on market quality in a systemic manner, this would be it. So we actually started writing this paper with the intention of finding evidence of fraud, malfeasance, manipulation, if you will, through naked shorting. Ultimately, we found exactly the opposite. We ended up writing this paper and concluding that even naked short selling was actually leading to improvements in market quality, especially through this liquidity improvement channel, because it was allowing liquidity providers to manage inventory in a better manner.
Interesting. So you went in actually thinking that you're going to find evidence that short selling is bad. That was your initial conjecture about the results. But actually, when you looked at the data, you found something completely opposite, that short selling, even naked short selling, was still beneficial on average.
It did surprise us. It really did. And, it feels like true science in action, or at least it did to me. So many times we start studies with a strong suspicion of what we are going to find, and then we confirm our existing knowledge, and certainly there's satisfaction in that. And yet, starting with a hypothesis of how this works and finding through years of work, frankly, that this hypothesis was wrong, leading us back to the table to studying the process more, developing a better understanding, developing a new set of hypotheses, running new studies, and eventually finding that, yes, indeed, our original preconceived notions were wrong, and this actually has a positive impact on market quality. It felt good. But the interesting thing is that there was an extreme amount of pushback. We published this shortly after the global financial crisis, and I guess defending short sellers after a financial crisis is never going to be a popular opinion. Now, we never finished explaining how naked short selling even works, right? In case somebody's still out there wondering, how can you sell a share that you haven't even borrowed and that you obviously do not own? The whole catch relies on the fact that at the time of us writing, most US securities were settling on a T+3 delivery system, which means you had 3 days to deliver a share. This was 2014, 15 when we published this paper, and we had regulation that was aiming at changing delivery systems. But it's interesting that even then, right, you live in this modern electronic world, and yet you still have 3 days to deliver shares like you're, like they're traveling by carrion pigeon across the country. But even in this corner of the market, we were finding these positive impacts in terms of liquidity and market efficiency connected to even this more extreme form of short selling. And effectively, what we were finding in our paper is that most of it was coming from financial intermediaries who were just not managing their inventory properly. You have multiple traders across multiple desks. 2 of them get phone calls at the same moment for the same Apple shares. One of them sells the shares that exist. The second one sells the same shares. Technically, now they're naked. And this is not what, when people are thinking of the predatory naked short seller, they're thinking of the guy manipulating the supply of shares, trying to distort markets. We were actually finding that that was extremely rare because it's risky and because it's costly, and because ultimately clearing houses will not. There's this fundamental misunderstanding in markets that if you fail to deliver shares, you can somehow profit from it, that many critics of short selling allege. And the reality is that usually until the short sale is closed, there's a clearinghouse that keeps the funds until you've settled everything. So this idea that you can somehow sell shares, pocket proceeds, and then just walk away and disappear is just not born in reality. Mm-hmm. And that's one of the things that we were finding in our paper.
What I still find most fascinating about your story is that you went in thinking that you'll find that naked short selling has a negative outcome. It's viewed from a negative lens, so to say. So that was your expectation. But what you actually find is that even though it's naked short selling, it still provides improvements in market quality. So it allows for prices to be more efficient and to better reflect information.
Yes, absolutely.
Yeah. So I feel like we've provided a lot of examples in our discussion today of these expectations of negativity associated with short selling. We've linked it to the GameStop example, to what the Pope has said, to this emotional connections that people might have. But then when we backtracked and brought in academic research, what it's showing is that a lot of this emotional reaction doesn't actually have any basis in actual data. What we see is that short selling brings about a lot of benefits. It makes prices more efficient. Short sellers are on average also correct about the information that they disclose. So they do find that the company isn't doing good, and they see it ahead of the overall market because firms and markets with more short positions end up experiencing lower stock returns later. So it seems like empirically, and the data tells us that short selling really is a force for the good, whereas the perception out there is sometimes that short selling is a force for the evil. This addresses our main goal of the podcast, right, where we wanted to bring in topics that have one perception out there in the public. But if you look into the data, you find actually a conflicting result. So here we're saying short selling brings in a lot of important information and some perceptions about it not correct.
Yeah, and you're right. And yet we probably should mention there are some academic voices that are critical of short selling. Markus Brunnermeier and Martin Omke have a paper in the Review of Finance published in 2013. By the way, Review of Finance, right? The European of journals. And again, I think there is a bias here when Europeans are looking at short selling versus America. I mean, we all try to be scientists, right? And yet perhaps we editorialize.
Well, as the papers we're talking about by Markus Brunnermeier, it's a theoretical paper.
The paper itself, there's an ominous title, right? Predatory short selling. And it actually focuses on financial institutions in particular. And the story here looks at the fact that financial institutions often have debt with covenants. These covenants are effectively contractual clauses that require financial institutions to maintain a certain ratio of debt to equity values. And the idea here is that short sellers, by inflating supply of shares, can drop the value of equity to the point that they trigger covenant violations, and in that way end up damaging companies, and this damage then ends up being profitable for short sellers.
It sounds like a plausible story.
Absolutely, and I think that your comment is a loaded comment, right? I mean, I can hear the objection in your voice.
Well, I mean, empirically, this theory isn't supported, but I'm going to highlight again, on average, I bet that their story might be true for like one or two instances somewhere there.
The point being, it's a very plausible story, right? And we all know that there are very plausible stories against short selling, and yet the empirical evidence is scant. Now, one of the series of papers that I actually do find have slightly more meat to them when criticizing short selling is actually work by Henry Hu and Bernard Black. This is actually work that mostly came out in law journals, not finance publications. They actually talk about empty voting. And you're the expert on shareholder meetings, Kate. And so empty voting, the whole idea here being that when shareholders in a company have isolated voting rights from cash flow rights, they can engage in shenanigans. So in other words, if I own shares in a company, I get to vote on these shares, and with those votes, I can make decisions on behalf of the company or force the company to make certain decisions. And if I don't own cash flow rights in the company, I can effectively strip this company of its assets, transfer those assets over to myself or to some other company that I own without incurring any economic damage. So the typical example of this is in the context of a merger. Say I'm a shareholder of company A bids for company B. I buy shares of company B, and then I short shares of company B. And there are some inefficiencies in the transfer of voting rights here that they document, which lead to effectively, now I can vote for company B without having any economic exposure. So when company A makes a merger offer for company B, I vote for a very low share price. As a shareholder of company B, I suffer, but my shares are hedged. I'm short, right? So I don't take an economic hit on that side. As a shareholder of company A, I profit and walk away, having bought assets, having bought company B for below market value. They had a series of papers where they were identifying instances of likely fraudulent behavior around shareholder votes. And they were showing that these instances of fishy behavior around shareholder votes were often correlated with high volumes of short selling, suggesting that short selling was enabling this kind of negative behavior.
Enabling negative behavior?
Yeah, the idea that by allowing you to hedge your position and separating cash flow rights from voting rights, now you have a way of stripping companies of assets. So short selling is effectively allowing you to create that wedge between cash flow rights and control rights that allows the stripping of company assets. you still look skeptical. Which part of this?
Empty voting is a truly interesting story. I'm just more interested in more straightforward stuff. I'm interested in the empirical results shows that short selling helps price discovery, and that's what I was concentrating on. And the empty voting, super interesting story, but just felt like it's a little bit outside of that main domain.
I think that the scales here are tipping very heavily on one side. We don't have a whole lot of academic evidence of the bad sides of short selling. So I thought that it was important to mention what is out there. And I do believe that this empty voting topic is slightly under-researched in a governance sense. But all right, so I think that we've been chatting about this for a while.
Let's summarize. Why don't you mention the 3 important points to you, and then maybe I'll do the same.
Well, I think the big summary here is that the bulk of the evidence finds that short selling contributes greatly to the quality of financial markets by facilitating the incorporation of negative news, both through a mechanical channel and through an incentive to dig, discover, and disseminate bad news. It has a separate positive effect on markets through the governance channel by keeping managers a little bit more honest. And then finally, it has subtle and yet probably the most important and meaningful in economic terms effects in improving the quality of markets and in particular market liquidity. And we didn't mention this, but there's an important paper, Alessandro Weber and Marco Pagano, Journal of Finance 2012, that finds that these improvements in market quality and liquidity are particularly important for small stocks.
So basically, short selling is viewed as evil sometimes, but when we look at the empirical evidence and when we look at the actual data, the data suggests that short selling is not evil because short selling allows for information to be properly reflected in prices, in the stock prices. And also it has a disciplining effect on management where if you know that somebody can short sell your company, you're going to be less likely to participate in fraud, to misstate earnings and try to mislead your shareholders, basically. Then also there's some additional benefits of short selling for this plumbing of the financial markets where dealers can better manage their inventory.
At some point, you have to figure out what do you mean with evil, right? And what philosophical paradigm do you take? I think that implicitly we are being utilitarian here. We are asking, is short selling contributing to the welfare of society or taking away from it? The implicit argument here is that better pricing efficiency leads to better allocation of resources, better allocation of assets to efficient use, means more jobs, faster growth, more food for all of us, and in general, higher levels of prosperity. Morality is subjective, and apparently the Pope would perhaps disagree with us, right?
Well, we don't know how he's going to reply to the CFTC statement yet.
The CFTC statement was followed by the Vatican's ban on short selling for its own internal funds. It's interesting because the Vatican is not necessarily contesting. Well, as you said, it would be interesting to see, have they thought about all these higher level effects, or is this a knee-jerk reaction? But it's interesting that they're taking a blanket view of profiting from the misfortune of others is wrong. And if you take that statement at face value, then it's kind of hard to defend short selling. I mean, you are profiting from the misfortune of others. You and I seem to buy this idea that profiting from a misfortune that we haven't caused is perhaps okay, right? But the Vatican didn't necessarily put that disclaimer out there.
Well, I think the hopeful message to me out there is that if a company is indeed good and the short sellers were wrong, then the company is going to continue to perform well, and short sellers are going to get hurt and lose money on their position. On average, short sellers are correct. But there are circumstances where, and as Alice Bonami's paper with Lance Bargeron shows, there are cases where firms end up going against short sellers and end up really showing that they're good firms. So that's a good recourse there. And then the short sellers are the ones who are losing out because they're already in a high-risk position.
I think we almost managed to go the full episode without talking about the most shorted company ever. Right?
Tesla short.
Yeah, indeed, right? I mean, and I'm so torn here. I've for a long time believed that Tesla is a bubble. And there were a lot of shorts out there that seem to believe so as well, and that they have put their money where their mouth is, and yet they have lost massive amounts of capital because the share price just keeps going up and up. So I don't know, is Tesla the exception here that confirms the rule and just proves that short sellers are not going to bring down a healthy company?
Well, hindsight is 2020, and time is on our side, so time will show.
Indeed. So, Kate, it's probably time to call it a night, right?
Yeah, I think we've covered a lot of anecdotes, a lot of information about short selling. What is short selling? How does short selling actually occur? If I were to summarize everything, it's to say to our listeners, do not be afraid of short selling. Short selling makes markets more efficient. Short selling brings important information to the markets. And short selling also improves liquidity. So there's many benefits to short selling, even though people might have a natural emotional dislike for short selling. It has a useful disciplining effect and a useful effect of bringing in needed information to the market. So I'd say don't be afraid of short selling.
I'm just afraid of somebody quoting you out of context here. I would tell to our listeners, you should be very afraid of short selling. I fully agree with what you're trying to say, Kate.
Don't have a negative perception.
Sellers.
Don't have a negative perception of short selling, perhaps.
Correct. And don't be afraid of short sellers. They keep prices in check and they keep markets honest and they burst bubbles. Be very afraid of short selling, right? It exposes you to a potentially unlimited amount of risk.
I see what you're saying. Right.
If you're short selling, make sure you know what you're doing. Make sure you follow the advice of investment professionals and not of Kate and I. We are not here to tell you how to manage your money. Please don't sue us. And be very, very careful if you're short selling.
Excellent. Thanks for listening. We appreciate your time. And if you liked our episode, please leave us some comments. Listen to us on your favorite platform. And
send us your questions in finance. Cheers.
Cheers.